So, let us continue from where we left off, payoff and profit diagrams. Now, the price of the underlying, which forms the substratum of the forward contract, invariably evolves as a stochastic process. What is a stochastic process? A stochastic process is a process which evolves with an element of randomness embedded in it. In other words, it is not possible at any point in time to precisely predict the trajectory of the process for all future time. I repeat, it is not practically possible to predict precisely the evolution of the process. It has an element of randomness, and at every point in time that randomness manifests itself. So, we cannot precisely sitting at t equal to 0 at any point in arbitrary point in time for that matter, we cannot precisely predict the trajectory of the process henceforth. So, that is a stochastic process, and obviously, the underlying assets prices follow a stochastic process, because as I mentioned, if the price process of the underlying is deterministic, that is, if it is perfectly predictable for all future point in time, if it can be given as a differential equation and which has a clear cut trajectory, then there is no point in writing a derivative contract, because the derivative contract's value would also be absolutely predictable, and then it would make no sense as performing functions of derivative contract. So, it would not be able to perform functions of derivative contract. So, it is necessary that underlying assets be only those assets which evolve with a certain element of randomness embedded in them. So, that is what we are talking about here. Hence, the value of the at the maturity of the derivative is a random variable. The value of the price of the underlying asset, the value of the underlying asset, the price of the underlying asset on the date of maturity of the derivative is a random variable. So, the payoff from the derivative therefore depends on the value taken by a random variable, and it is a function of a random variable. It is therefore useful to ascertain the payoff from the derivative corresponding to different possible values of the underlying price. This is usually done through payoff and profit diagrams. So, let me explain it. You see, at t equal to capital T, which is the maturity of the derivative, the value that the underlying assets price could take is a random variable. Now, corresponding to the value that the price of the underlying asset could take, the payoff of the derivative is determined at the date of maturity. Therefore, the payoff is a function of that random variable, which is the price of the underlying asset. Now, it is very convenient, it is very useful for the purposes of establishing strategies sitting at t equal to 0 to have a feel about how the payoffs are going to behave given different values that the price of the underlying asset, which is a random variable, could take. So, that is done through payoff diagrams. We take a spectrum of possible prices of the underlying asset, because it is a random variable, we cannot predict it exactly, but we can have a spectrum of prices such that the price could lie between this particular set of values, and then on that basis of corresponding to each such value that is a possible candidate for the price of the underlying asset, we calculate the payoff. And the graphical representation is called the payoff diagram, and the mathematical representation is called the payoff function. So, a payoff or a profit profile is the graphical representation of the payoff under the contract as a function of the market price of the underlying asset. So, that is what I said. This market price is the random variable. Okay. So, we identify certain possible values of this market price, and corresponding to each of these values, we try to work out the payoff of the derivative. We plot the payoff of the derivative corresponding to each of these values. This is called the payoff diagram. A payoff function is the mathematical representation. For example, payoff of a long asset position. Suppose you have bought an asset, bought a share of, let us say, RIL at t equal to 0 for a certain price, let us say INR 2000, and you want to work out the profit or the payoff that is going to be generated when you sell the asset 3 months hence, which is t equal to capital T, which is your maturity period or which is your investment horizon. Okay. So, now the price of the RIL share at t equal to 3 months is a random variable. Let us say it could take any value between 0 and say infinity. The corresponding payoff would be what? It would be equal to the price at which you are going to sell the asset in the market. Therefore, the payoff of a long position in a share is equal to the then prevailing market price of the asset, which we call S capital T. Capital T represents the maturity, S represents the price of the asset. So, S capital T is the price of the asset at maturity, a random variable. Please note, this is the exercise which is done at t equal to 0. So, we do not know what exact value S t is going to take, but we have a feel of what possible values, for example 0 to infinity, that S t could take, and then corresponding to that that is the payoff from holding one share of RAL. Now, suppose I had bought the share at RAL at 2000, then what would be my profit? My profit would be whatever the price it is at maturity, that is ST minus 2000, because 2000 is my cost. So, this is called the profit function. S pi long is equal to ST, this is the payoff, and small pi long is equal to ST minus S0, where S0 is the price that I paid for buying the asset. So, the net profit is ST minus S0. This is for a long asset position, and the inverse would be for a short asset position. What is a short asset? How will you create a short asset position? You borrow the asset, sell it in the market at t equal to 0. You borrow the asset, sell it in the market at t equal to 0. Your intention is that at the end of the investment horizon, you will buy the asset from the market in anticipation of the prices having gone down. So, you will buy the asset at a cheaper price and replenish the asset to the original owner of the asset, and in that case obviously this would be the payoff and the price functions and the profit functions, I am sorry. So, minus ST would be the payoff, because you buy the asset at maturity and deliver it to the original owner. So, that will entail a cash outflow of ST. So, it is minus ST, and the profit would be S0 minus ST, the price at which you have sold the asset at t equal to 0 minus the price at which you have bought the asset at t equal to capital T for replenishing it to the original owner. So, the small pi of a short position, the profit function of a short position is equal to S0 minus ST, and the payoff is equal to minus ST. It is interesting to note here that pi of short is equal to minus 1 into pi of long. That shows that this is a zero sum game. Profit diagram of a long and short forward position. What is a long forward position? A long forward position is a position where the holder of the forward contract or the party to the forward contract who is long has the right to buy the asset at a predetermined price. Let the predetermined price be K. So, as on date of maturity of the forward contract, the long position will receive the asset and pay a price K, and if the whatever is the market price of the asset as on date of the maturity, let us call it ST. So, you can sell that asset in the market at ST and pay off the forward price K. So, his net payoff is ST minus K, which is also his profit. And for the party who is short in the forward contract, who is delivering the asset, he has to buy the asset from the market at ST and deliver it to the long position or the long holder of the forward contract, and he will receive a price of K. So, his profit function is K minus ST, his payoff function is also K minus ST. Now, we talk about forward pricing, arbitrage free pricing under a forward contract. For that purpose, before we proceed further, we need to classify assets into two types of assets. Number one is investment assets, number two is consumption assets. Why? The rationale behind considering the pricing of forward contracts, of pricing under forward contracts with this discrimination of investment assets and consumption assets will become clear to you as we progress with the pricing, but basically let us now define the investment assets and consumption assets. Investment assets are assets held by significant members of people purely for investment purposes like gold, silver, shares and so on. Consumption assets are assets held primarily for consumption like copper, oil, coal and commodities, edibles, oils and so on. No arbitrage pricing of forwards investment assets. First of all, we will consider the arbitrage free pricing of forward contracts, arbitrage free pricing under forward contracts on investment assets. We make some fundamental assumptions, some simplifying assumptions. No income from the underlying during the life of the forward contract, no carrying cost of underlying during the life of the forward contract, no transaction costs and market frictions, no bid-ask spreads, no lending borrowing spreads and no commissions. So, these are some simplifying assumptions. We now consider the simplest model for the pricing under a forward contract of an investment asset. Let us say it is a share. So, let us look at this table here. This is t equal to 0, this is t equal to capital T. At t equal to 0, I undertake some transactions. What are those transactions? I borrow a sum of money S0 from the bank at a certain rate of interest, let us call it R. We shall be more clear on what R represents as we progress along this derivation. So, S0 is the amount that I borrow. What is S0 by the way? S0 is the current market price of 1 unit of the underlying asset. S0 is the current market price, t equal to 0 market price of the underlying asset or 1 unit of the underlying asset. So, we borrow an amount S0 from the bank at R% per annum continuously compounded, and we use this S0 which we have borrowed from the bank to buy 1 unit of the underlying asset, which we keep with us in safe custody. Against this position or against this holding of the underlying asset which I have with me in my locker, I write a forward contract. I take a short position in a forward contract. Remember, what is a short position in a forward contract? A short position in a forward contract involves the delivery of the substratum, delivery of the underlying asset in exchange of the forward price. Let K be the, or let F0 rather, let F0 be the forward price which is agreed at t equal to 0. So, this short forward envisages what? It envisages no cash flows at t equal to 0. So, it is 0 here, but at the maturity, that is t equal to capital T, it will involve what? It will involve delivery of 1 unit of the underlying asset, and in exchange thereof the party who is long in the forward contract will give me a price which I call F0, which is agreed at t equal to 0, and hence the suffix is 0. Now, at maturity t equal to capital T, what will happen? I will deliver the underlying asset which I have with me in my possession in my locker. I will deliver it to the party who is long in the forward contract. Against that, the party who is long in the forward contract will give me the forward price which is F0. Out of this F0, what will I do? I will repay the amount that I have borrowed from the bank together with interest. So, the amount that I have to repay to the bank is S0 e to the power RT, where R is the continuously compounded rate of return, rate of interest on the borrowing from the bank. So, the total cash flows, if we work it out, at t equal to 0 is equal to 0, and at t equal to capital T, it is equal to F0 minus S0 e to the power RT. Now, on the presumption that the entire process is risk free, what happens? Because there is a cash flow of 0 at t equal to 0, arbitrage free pricing necessitates that the cash flow at the maturity of the derivative contract, maturity of the forward contract must also be 0. Hence, this must be 0, and that gives us this formula for the forward price. Please remember, this is the arbitrage free price under a forward contract, given the assumptions which we have already talked about. And there is another catch here. The another catch is there is no default risk of any leg of this transaction. The entire process is default free, and as a result of which, because my initial cash flow is 0, it must necessarily be true that my final cash flow should be 0. Otherwise, arbitrage process will get invoked, and the usual implications would be that the prices will realign themselves, so that this equality is satisfied. Why the risk free rate? Now, this is interesting. What is R? R is the risk free rate. R is the risk free rate. Why is this the risk free rate? You see what is happening. In this case, what was the process? We borrowed an amount from the bank, we bought the asset from the market, and then we wrote a short forward contract on the asset. Now, the important thing is we are assuming that the forward contract is default free. If the forward contract is default free, it necessarily implies, it necessarily means that we are certain to get the amount of F0 at maturity. We already have the asset with us in our possession, so we can deliver it without default. So, that leg of the transaction, that is as far as the forward is concerned, on the premise that the counterparty is not going to default, is entirely default free. And because I have the amount of money F0 and that amount is going to be used for the repayment of my borrowing from the bank, this portion is also default free, and as a result of which the entire process is default free, and the rate of interest the bank is going to charge me must therefore be the risk free rate. That is the rationale behind using the risk free rate in the context of forward pricing. Now, forward pricing with dividends. What happens if during the life of the forward contract a dividend is envisaged, a dividend is expected to arise out of the holding of the underlying asset? Then what happens? Let us see how it impacts the pricing process of the forwards. Let us look at this table again. It is pretty much similar to what we had in the previous case. Now, again we assume that the spot price of the underlying asset per unit is equal to H0, and we borrow an amount of H0 at the rate of return R, rate of interest R, continuously compounded from the bank, and use this amount H0 to buy 1 unit of the underlying asset which we keep with ourselves. So, borrowing H0, using that amount H0 for buying the asset means the cash flow is become 0 at t equal to 0, and at the same time I have 1 unit of the underlying asset in my custody, in my possession, in my ownership. Now, I write a forward contract on this particular 1 unit of the underlying asset that I have in my ownership. Then what happens? Because I have a holding, I have ownership of this asset, I will obviously get it transferred in my name in the books of the company. Therefore, if and when the company declares dividend during the life of the forward contract, that dividend would accrue to me. That dividend would accrue to the party whose name appears in the register of members of the company, and that would be me, because I have bought the asset from the market at t equal to 0 and I am holding it in my possession. So, I will get an amount, that is an inflow that will occur at, let us say, t equal to tau, where tau is any point in time between 0 and capital T. Capital T is the maturity of the forward contract, 0 is today, and tau is some point in between 0 and capital T. What I do is I reinvest this amount d tau for the remaining life of the forward contract at the same interest rate R, and what I will get is dt. What I will get is dt at maturity. So, let us see what happens at maturity now. At maturity, I have got 1 unit of the underlying asset with me. I will deliver that asset under my short forward position. Against that, I will receive the forward price F0. Please note, I repeat again, this F0 is agreed at t equal to 0, and therefore, the suffix 0 is attached to this F. F represents the forward price at what point in time? At t equal to 0 for a maturity of t equal to capital T. In addition, I will get the amount that I have invested for dividend, that is d capital T, the future value of the dividend from tau to capital T for an investment from tau to capital T, and out of this, that is dt plus F0, I have to pay off the borrowing that I have made at t equal to 0 for buying 1 unit of the asset in the market, that together with interest, and that will become S0 exponential RT. So, again, because the entire set of transactions is default free, the entire process is default free, therefore, the cash flow at t equal to 0 is 0, there is no intermediate cash flow either. Whatever intermediate cash flow we had received was invested forthwith, and therefore, the cash flow at t equal to tau is also 0. There is no other intermediate cash flow, therefore, the maturity cash flow must also be 0, because it is a set of risk free transactions. So, that gives us this equation, and on simplifying this equation, we get this expression for the future price of an asset, which has which delivers or which is likely to deliver a dividend during the life of the forward contract. Please note, what is this D0? D0 is the present value of d tau. D capital T, let me repeat two things. D tau is the actual dividend that you receive at t equal to tau. D capital T is the future value of that dividend that you receive at t equal to tau calculated at t equal to capital T, and d 0 is the present value of the dividend that you receive at t equal to tau calculated at t equal to 0. Forward pricing with yield. Very often it happens, particularly when we talk about index futures and such other things, that we, instead of assigning a particular amount of profit on holding futures contracts, we assign a yield that is going to be likely to occur on the underlying index. And even for spot indices, even for the, let us say, BSE index or the NSE Nifty or so on, it is customary that we use the yield, exponential continuously compounded yield, instead of the value, the absolute value for specifying the return on holding or taking a position in these indices. So, under these circumstances, when you are given a continuously compounded yield on your holding of the underlying asset, what happens? What is the forward pricing? That is our next exercise. So, let us assume that the holding of S generates a yield Q per unit time. Therefore, if you want to have 1 unit at time t, for delivery against the forward contract, you need to have only exponential minus qt units now. Or alternatively, if you have 1 unit of the index or the stock at t equal to 0, the 1 unit will grow to e to the power qt units at t equal to capital T, given the yield as q per unit time. So, that is what we are going to make use in the pricing process. Again, we look at this table, we borrow a certain amount of money, S0, which is the current price of the index or the stock, let us call it stock for the sake of simplicity, but we are given a continuously compounded yield on that stock instead of an absolute dollar value of dividends. So, S0 amount you borrow at R% per annum continuously compounded by 1 unit of the stock. So, the net cash flow at t equal to 0 is 0. And now is the catch. Against this holding of 1 unit of the underlying asset that you have with you, that you have in your possession, you write a forward contract, you take a short position in the forward contract, not for 1 unit, you take a short position in e to the power qt number of units of the underlying asset. I repeat, you take a short position in the forward contract for e to the power qt units of the underlying asset. Why? Because this 1 unit that you have bought at t equal to 0 will grow to e to the power qt units at t equal to capital T, where q is the rate of growth per unit time or the continuously compounded yield, as you call, per unit time. So, this t equal to 0, 1 unit will grow to e to the power qt units, and therefore, you can deliver e to the power qt units against your short forward position. Therefore, you write a short forward contract or take a short position in a forward contract, not against 1 unit, but against e to the power qt unit. So, what will be the maturity cash flows? Because you have a short forward position for e to the power qt units, the payment that you will receive against the short position will be equal to F0 e to the power qt, where F0 is the price per unit of the underlying asset in the forward market for maturity at t equal to capital T. So, instead of F0, you will now get F0 e to the power qt, and against this you have to pay back the loan with interest, and that is S0 e to the power RT. Again, on the same premise that we have discussed earlier, the cash flow at t equal to 0 are 0, there is no risk embedded in this set of transactions, and therefore, we assume that the forward is default free, and therefore, the maturity cash flow must also necessarily be 0, and that gives us this equation. That gives us this equation. Now, if instead of dividends we have carrying costs, the sign of d0 will be reversed and the sign of y will be reversed, and we get these equations, we get these expressions. In the event where instead of cash inflows by virtue of holding the asset, we have to pay a cost for example, the go down rent, for example, insurance costs, protection against embezzlement, evaporation of the underlying liquid or fluid, and such other expenses that may arise by holding the underlying asset in your possession, in your ownership, then the signs would be reversed, no other change in the derivation process. So, these equations will take over. Instead of S0 minus T0 exponential RT and S0 exponential R minus QT, we will have S0 plus U0 exponential RT and S0 exponential R plus Q into T. Now, we have worked out certain formula on the basis of the assumption that there will be no arbitrage, and if there is a differential, then arbitrage will converge the two legs, that is the spot leg and the forward leg together, so that we in the arbitrage free situation we have these values which we have already seen earlier. F0 is equal to S0 e to the power RT. This is the situation which would arise when we are in equilibrium without any arbitrage opportunities. The next question that I want to address is that if this equality is violated, what would be the arbitrage process? How would arbitrage actually activate itself? What would be the steps that an arbitrager will undertake in order to profit from this mispricing? That is the next question. So, let us assume that the actual forward price, which I write by F0 star, which is the actual forward price, which is the forward price prevailing in the market corresponding to a negotiation at t equal to 0 and a delivery at maturity at t equal to capital T, and F0 is the arbitrage free forward price, which is equal to S0 e to the power RT. Let us ignore for the moment dividends and carrying costs and yields and so on. Let us keep that traction simple. So, let us assume that for the moment F0 star, the actual market for price in the forward market is higher than the no arbitrage or the arbitrage free price corresponding to the same delivery date of the same underlying asset. Then how does arbitrage take place? Now, clearly this is larger and this is smaller. So, we buy the smaller leg and we sell the larger leg. How do we do it? It is quite simple. Buy the smaller leg means what? Borrow the money S0, buy the underlying asset and write a forward contract on that for delivery of the underlying asset. On maturity, what happens? You deliver the underlying asset, you receive F0 star. Please note this, that is the actual forward price, and you receive the actual forward price. You receive F0 star. You pay what? You pay S0 e to the power RT, that is the amount of S0 that you borrowed together with interest thereon. So, your profit is equal to F0 star minus S0 e to the power RT, and from the assumption that we have made here, this is greater than 0. So, let me now go through stepwise. Consider the following strategy at t equal to 0, borrow S0, buy asset and hold the asset for 0 to capital T, take a short forward position at t equal to capital T. What happens? Deliver the asset against the short forward position, receive cash, F star 0, the actual forward price. Pay off the loan with interest S0 e to the power RT, and you, because F0 star is greater than S0 e to the power RT, you make an arbitrage profit. So, what will happen? Everybody will start doing this, and this particular quantity F0 is greater will decrease, because everybody will start writing forward contracts and buying in the spot market, and this will increase, and as a result of it, this differential will gradually be wiped out at equilibrium. Reverse cash and carry arbitrage, what happens is F0 star, that is the forward price, actually prevailing in the market is less, and the no arbitrage price or the arbitrage free price corresponding to the same underlying same maturity is higher. Then we do the reverse strategy. What do? We take a long position in the forward contract, and against that long position in the forward contract, you borrow the asset at t equal to 0, sell it in the market at t equal to 0, use the proceeds, that is S0, to invest at the rate of R for maturity at capital T. At maturity, what will happen? Because you are long in the forward contract, you will receive the asset from the party, and the asset that you will receive, you will replenish it to the party from whom you have borrowed, and as far as the investment amount is concerned, you will receive S0 e to the power RT, and against your long forward position, you have to pay a price for receiving the asset of this much. Please note, the asset that you have received will be replenished to the person from whom you have borrowed it. So, that cancels out, and the price that you have received in the forward market is you have paid. Please note this. This is the price that you have paid in the actual forward market when you took the position at t equal to 0, and this is the proceeds of the investment when you made at which you made at t equal to 0. So, by assumption this is greater than 0. So, here again you make a arbitrage profit, right. So, that is as far as cash and carry arbitrage is concerned, and reverse cash and carry arbitrage is concerned. In the reverse cash and carry arbitrage, please note what we do is we take a long forward position. That means, we are going to buy the asset in the forward market at the actual forward price, that is f star 0, and against this you sell the asset that you have you take a short position in the asset, you borrow the asset from somebody, you sell the asset in the market, you get an inflow of S0 at t equal to 0, you invest that inflow at t equal to 0 at the rate of R%, so that it becomes S0 e to the power RT at maturity. From this, against your long position, you have to pay the price of getting the asset, which is F0 star. So, the net proceeds, net cash that is available for you is S0 e to the power RT minus F0 star, and the asset that you will receive under the long forward position will be used for replenishing to the person from whom you had borrowed the asset at t equal to 0. So, that is how reverse cash and carry arbitrage operates. Shall continue from here. Thank you.